Are you a GEPF member who has worked before March 1998? If so, you could be entitled to a significant tax savings benefit. Unfortunately, though, many members lose out because they don't know how to claim it. Now, if you don't want GEPF to take away your pre-98 tax savings, and if you want to learn how you can maximize it, this video is perfect for you. I'm Devan Naika, and I help GEPF members like yourself make one of the most important financial decisions, which is whether you should retire or resign. In this video, I'm covering everything that you need to know in order to understand the pre-98 tax benefit. Now, let's get started straight away. I want to start by giving you a framework, just an understanding as to how pre-98 benefits have come about. And again, we'll go into how you can maximize it. Now, when I'm doing this, I like to draw timelines, and I encourage you to do the same. In fact, right at the start here, I want you to watch this video twice. So the first time that you watch the video, I want you just to understand the framework, right? So understand how I'm doing the calculations, what am I doing, what's the procedures to follow. Then watch the video the second time around, but the second time I want you to watch it with your actual GEPF statement so that you can do the calculations, right? Once you understand the framework. So I like to get it done visually so that I understand what's taking place, and this is how I'm going to teach it to you. So what we do know is here is March 1998. Now, just so that you understand the basis where this has come about, where the pre-98 tax benefit came about, if you were a government employee and you were working for government, obviously before March 1998, whatever was before 1998, and you left work, you could take out your benefits, all of it, and it was completely tax-free. So you could withdraw every single cent and it was tax-free. Then on the 1st of March 1998, there was a change to the ruling, and basically what had taken place was they said going forward, anyone who's leaving, their benefits are going to be taxed, right? So meaning going forward after March 1998, their benefits are going to be taxed. Now, if you are working before 1998, it means you're losing out, right? Because you had some of your years of service before and some of your years of service after, which means you're losing out on a portion. To ensure that they create balance, that they create a balance, this is where they allow you this pre-98 tax benefit. And I'll show you how to calculate it now. I'm going to use an example just to make this look easy, right? So let's assume that you had started work. Again, remember, you're watching the video twice. First time, you're just understanding how I went about doing the calculation. So let's say that you started work. In my example, I'm saying March 1990. So I'll put it as March 88, right? So I'll put it at March 88, which means from a calculation perspective, that gives us 10 years, right? Let me draw this graph again for us. So I'll say here, started work on 1 March 1990. And then this is the next period, which is March 98. Pardon me, I'm doing this one again. That's March 1990, I'm saying March 88 again to make the math look easy, right? So you can follow this well. So which means from 88 to 98, you've got a 10-year period, right? Which means that 10-year period, remember this is the tax-free portion here, right? That's tax-free. And then we're working at a time when you are leaving. Now I'm going to use an example here. And let's say that you are leaving in, I'm just using March 23. So March 2023. Obviously, you'll put in the age or the year that you are leaving, right? So which means in this portion here, from March 1998 to March 2023, there's a 25-year gap here, right? It's a 25-year time horizon. And this is where the benefits are taxed, right? Which means if you look at how I've gone about this, the total years of service for this member, I'm adding 2, it's 10, which is the pre-98, plus 25. So total years of service for this member is 35, right? It's 10 plus 25. Now, here's the formula, so pay careful attention. Out of the 35 years, 10 years are tax-free, right? So 10 divided by 35. 10 out of the 35 years are tax-free. So let me explain how this works. It means there's a portion of your money that's going to be tax-free before 1998, and that's the figure which I'll help you to calculate now. And there's a portion of your money that's going to be taxed, and that's the portion that is after 1998, right? Again, I'm going to be pulling up a member statement now and doing the calculation for you. You're going to then follow this video again a second time around to understand it for yourself, right? Now, why this is such a key benefit to know is this is a tax-free benefit that is in addition to the 500,000, which has now been increased to 550,000 tax-free. So I'm going to show you a tax guide just now, and I'll show you how the guide works. In fact, let's head over to the tax guide. This is critically important for you to know. Now, please, when you are doing this, I want you to make sure that you are working with the latest tax guide. You can see I'm working with the tax guide for 2023. Make sure that you are working with the latest tax guide, right? In this particular tax guide, you can see, I'm heading over to this table here, the retirement fund lump sum benefits or severance pay. Now, this used to be 500,000 that was tax-free, right? And for this particular tax year, it's now increased. It's gone to 550. Again, when you're watching the video, make sure you're getting the latest tax guide to see if it's increased. What this means is, if you have 550,000 that you are withdrawing, it's going to be tax-free. Now, why I'm explaining this to you is the Pre-98 is in addition to this, right? It's in addition to this. So let's head back onto the iPad. So whatever we're going to be calculating now, whatever benefit I'm going to be calculating when I get to this figure here, in addition to that amount, you also got another 550,000 that's tax-free. So in essence, it's two tax-free amounts, right? 550. Yeah. Now I'll show you how to work all of this. Let's head over onto a member statement, right? And then we'll get the calculation done thereafter as well. Okay. Now, again, you're going to follow along on this statement when you're watching the video the second time around. Follow along on your statement, right? Firstly, when you're getting the statement, please make sure you try and be as accurate as possible. So you notice at the top of the statement, it's got a year. Try and get this close to, or it's got a date. Try and get this as close to the time that you are leaving, right? Meaning if you are leaving in 6 months' time, then get the estimate of benefits as at that date that you are leaving, right? Try and make it as close as possible so the figures are accurate. Now, the important things I want you to pay attention to here, one is in terms of the lump sum gratuity. So can you see the lump sum gratuity here? It's 1.2 million for this particular member. So you want to pay attention to that, right? Because it is a taxable benefit, right? So we're going to calculate how much tax would be paid. I also want you to pay attention to the resignation benefit here, right? You also want to have a look at this because, again, it depends on which route you're taking, whether you are aiming at resigning or retiring. So we're going to focus on these two figures, the 5.1 million that I've shown you now, as well as the 1.2 million when I'm doing the calculations, right? So we'll work this out exactly according to that. Let's head back onto the iPad. Now, when you are doing this calculation, the next step is just an understanding. So I'm taking you back a little, just to understand the process, right? What would take place on resignation, because it differs slightly, right? You could end up with a significant amount more that's tax-free with resignation, as I'll show you now, as opposed to retiring, right? But just understand the framework of how this is. So presently, if you have money sitting within GEPF, as I showed you in the statement just now, if you are aiming at retiring, you're going to get the amount that they show you as a lump sum gratuity, right? And the amount that we saw for this particular member, if the member had to retire, I'll write on the exact figure here. It's 1,257,641 rand, right? That's what this member is going to be receiving as a lump sum. If the member opts to resign, so let's say you are aiming at resigning, you could cash out, in which case you're going to pay a fortune in tax, right? Let's say you are aiming at moving to an approved fund. So that creates some tax savings for you. But once you're in the approved fund, that's not the end place, right? You have to come away from the approved fund. And this is where you are entitled to take up to 1/3 in cash, right? And then the balance of that money, the 2/3, is what's going to be invested. You invest that and you start paying your income. Now, why I'm explaining this part again is, I want you to see that the resignation value for this member was sitting a lot higher. The resignation value was sitting at 5.1 million, right? So let's head back onto the calculation, onto that statement so that you can see it. So here you notice that the member's resignation value was sitting at 5,119,000. I'm going to round that up. I'm going to say 5,120,000. And then the 1/3 value is going to be that figure divided by 3, right? So the resign value here is 5,120,000. In order to calculate the 1/3, I'm merely dividing by 3, right? So I'll pull up a calculator. You don't have to do this. You can just follow along on the calculator. So let's see, 5,120,000 divided by 3, that gives you the 1/3, which means this member should have 1,706,000, right? That's the amount that the member should be taking. I'm rounding the figures up here just to make the math look easy so that you can compare and follow along, right? Which means if you look very closely, if this member had to retire, the lump sum, the cash lump sum the member is going to get is 1,257,000. If the member aims to resign, it's now 1.7 million as a lump sum, right? So that's like over 450,000 rand extra that's sitting inside the resignation pool, right? For this particular member. Now, why this is important is when I'm doing the tax calculation on the Pre-98 benefit, you then will have an understanding as to which one would be tax-free, right? Meaning, is all of this going to be tax-free or all of this is going to be tax-free? If all of this is tax-free, that means there's an extra 450,000 that you're getting in your hand tax-free, right? And you can imagine now how much of value that can be for you if you're able to put yourself in that position. So here's the calculation. This is the formula. You're taking 10 divided, so your years of service before March 1998, divided by your total years of service, right? Now remember, this is not 100% accurate here. There's ways to get this done more accurately. I'm just giving you the framework, right? The structure of it. So it's 10 divided by the total years of service. And the answer to that, you are going to multiply by your resignation value. Now, in this case, for this particular member, if you remember, the resignation value was 5,120,000. So again, I'm going to do the calculation for you. I'll pull up the calculator so you can see. I'm starting with the years of service before March 1998 is 10, divided by the total number of years of service, which is 35, right? So this little calculator here, this little figure, then I'm multiplying it by 5,120,000. That's the resignation value, right? This then gives me what the tax-free amount is, right? So the tax-free portion for this particular member, I'll put it up on the iPad. You can see it on the screen. It's 1,462,000. I'm rounding the figure up again, right? Just so, again, the math looks a bit easy. Now we want to look at that in relation to the gratuity, right? So remember the gratuity, what I showed you on the statement, was 1,257,000. If you remember, as per that member statement, right, which we have here, 1,257,000. That's the gratuity. Now, here's the interesting thing. So pay careful attention. Notice that the Pre-98 tax-free benefit. So let me list this as Pre-98. So your Pre-98 tax-free benefit for this member is 1,462,000. Meaning, if this member wants to withdraw some money in cash, the member can take up to 1,462,000 cash and will not pay any tax, right? Now, can you see that the gratuity is less than this? Now, because the gratuity is less, it means the entire gratuity is going to be tax-free for this member, right? According to this calculation. Now, you can follow along when you're doing your own calculation with this, right? It means the entire benefit is tax-free. Now, let's go look at the resignation, right? We saw that the resignation value was much higher because the member is able to get to what I call the true 1/3 value, right? It's not a formula based by GEPF. This is the actual 1/3 value, in which case we saw the 1/3 value being 1,706,000, right? This is what we calculated here. Now, here's the interesting thing, right? Remember, the Pre-98 tax-free benefit is 1,462,000. But in addition to that, the member also has, as I shared with you earlier, the member also has 550,000 that's tax-free, right? This is according to the tax table. So, which means you can add a further amount to it, right? So the total tax-free benefit will be calculated as follows. In fact, let me put up a calculator so that you can see how I'm going about it. it's going to be 1,462,000 plus 550,000, right? Meaning the total tax-free is 2,012,000. Now, when you go back onto the statement or the calculation that we've been doing, you should start to see the picture very, very differently now, right? In this case here, the member's resignation benefit is 1,706,000, and the total tax-free is 2,012,000 for this particular member. What it means is, if the member takes 1.7 million out, all of it in this example is going to be tax-free, right? Now, I want you to see where the member could have lost out in this case, right? If the member opts to retire, the member is in essence losing out on 450,000 Rand tax-free money, right? How am I calculating that? 1.7 million minus this, meaning the member can take a higher amount that's tax-free, but the member is limited because GEPF, according to the formula, provides what the gratuity amount is going to be. Now, when I mentioned to you earlier, don't let GEPF take away your Pre-98 tax benefit, this is what I was referring to, right? Because if you are aiming at retiring, you have to bear in mind that the gratuity is predetermined by GEPF. It's not necessarily a true 1/3 value of your resignation benefit, right? Which means if a member is aiming at resigning, again, following the example as I've shown you here, and you have the years of service, you can actually be entitled to most of your money or all of it that's going to be tax-free. Now, I know there's a lot that I've covered in this video, so I want you to watch it a second time around, just so that you understand it and do the calculation for yourself. Remember, draw the timeline, right? You want to have an understanding as to your years of service before, then you draw to March 98, and then the time period that you're working up until, right? Now, this is not the end of the video, because I want you to bear in mind, in addition to this, there are also certain fine print that SARS uses when they're calculating the tax-free benefit, right? Meaning they can look into any retirement annuities that you had, or if you had done any withdrawals before. So there's certain things that they take into account when they're determining this calculation. It's not a hard and fast rule. But what if you could find out what your tax-free amount is before you withdraw any money? Now, yes, that's an important statement. I'm going to go through it again, right? Usually what happens for members is the member only finds out after they withdraw out their money how much is paid to SARS, right? How much is lost in tax. The problem with that is when that money gets paid in this particular way, there's no way to recover it. It's lost forever. What if there was a way to counter that? Meaning before you withdrew out your money, what if you knew in advance what was going to be taxed, right? And the reason that it's so difficult for members is your resignation value is always changing, right? The longer that you're going to be with GEPF, usually the higher the value is. But sometimes GEPF could also adjust the formula. And if they adjust the formula, then your resignation benefit could reduce significantly. And that again changes the formula. Now, if you need assistance on getting the calculation done accurately, if you are aiming at resigning and you want to know how you can maximize your Pre-98 tax benefit, then I encourage you to send me an email. The email will be found in the description below. And I'll guide you again on how I operate with members. What are some of the benefits that I can show you? And again, what are the things that you can do in order to get the maximum tax-free benefit on this Pre-98? Great, so I hope you found the video helpful. In fact, I want to hear from you, so post a comment below. Were you aware of how this Pre-98 benefit is working? What information has been helpful for you? What are your key takeaways when it comes to this decision, again, of whether you should retire or resign, right? So post your comments below. If you found the video helpful, please give me a thumbs up sign so I know I'm on track with you and helping you the way that I want to. Also, I want you to post comments below if there's any questions, any information that you're uncertain about. Let me know so that I can always shoot another video to provide a lot more clarity to you. Lastly, if you know of any member who has been working before March 1998, I urge you to please share this video with them, right? Let them be aware so that they are empowered to make a more informed decision. I'll catch you on the next video.